Hey, what is up everyone? It's David here. In this video, we are going to talk about bank stocks, and I am going to provide an update on whether I still think bank stocks are worth our attention as dividend growth investors. Now, as many of you know, I did start off my investing journey from a dividend growth perspective. So quite a big portion of my portfolio is still dedicated to that. At the same time, towards the end of this video, I'll do a mini portfolio update. And as usual, this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes. So this video is mainly going to be broken into three parts. First, we need to cover some of the important metrics to pay attention to when it comes to the banks, and then I'll talk about the valuation, and then I'll wrap up at least that segment with my own verdict on whether I think the banks are still worth my attention. Last year, in June 2020, I dedicated a full video documenting my process on the big four banks. And one of the more important graphs, in my opinion, is the positive feedback loop here. And there are three main metrics that we are going to focus on in this video. And that's efficiency ratio, common equity tier 1, and then also return on equity. The main reason for these three is that everything starts with an efficiency ratio, because the efficiency ratio tells us how well are the banks managing their expenses. Because at the end of the day, if they manage their expenses really well, it means that the banks can invest more into their common equity tier 1 layer so that they can lend out more, which ultimately improves the return on equity. Before we take a look at the efficiency ratio, just so you know, it's calculated by the non-interest expenses divided by operating income minus loan loss provisions. It's expressed as a ratio. We want this to be as low as it possibly can be, and this is all just gauging how well the banks are managing their expenses. That's it. I have already done most of the hard work, and if you want to do your own calculations and fact check me, please feel free to do so and let me know in the comment section below if there was any standouts. But we want this number to be as low as it possibly can be. And you can see that amongst the five banks, they have really worked hard to bring that number down. Some have done a better job compared to others. Macquarie has done a relatively good job, and so is NAB as well. I have to say, when I did my ASX banks video last year, NAB did not have one of the good records. They have one of the worst track records when it comes to efficiency ratio. And towards the end of 2020, they have really brought that baby down. And now they have one of the best efficiency ratios amongst the five. Amongst the five banks, they're not the same. Macquarie tends to have a much stronger international presence, and they're what you call an investment bank. They make majority of their money via infrastructure lending, asset management, and M&A or IPO transactions, whereas the other four tends to have a much smaller international presence, and banks like Westpac and CBA tends to make majority of their money via home loans. Whereas NAB tends to have a stronger presence with small business lending. So if you are interested in them, make sure you do a little bit more digging just to see how they make money is aligned with where you think the world is going towards. From an efficiency point of view, NAB had one of the worst records last year, and now they're leading the pack. So that's a pretty interesting insight. And the next thing we'll look at is the common equity tier 1 ratio. With common equity tier 1 ratio, the general rule of thumb is the higher the better. And you can see that CBA is leading the pack here, with everyone else kind of close to the same. And what this ultimately tells us is that the banks are well capitalized. And I think it's unlikely that there'll be an event that could potentially collapse the banks. The last thing I like to pay attention to is return on equity. Again, everything starts with the efficiency ratio. If the banks don't manage their operating expenses well, it'll drag down all the other metrics. And you can see that NAB had one of the better records in 2020, and rightfully so, because they manage their operating expenses well. Not to mention, the other four banks didn't manage their operating expenses as well, so they had a bit of a declining record. So we just looked at the efficiency ratio, common equity tier 1, and also return on equity. And it really seems like NAB is leading the charge, and I was not expecting that. At the same time, with the acquisition of 86400, it seems like they're really onto something here and they're gaining momentum. So I think the 86400 will give them potentially an edge when it comes to acquiring younger customers, but we'll see how things go. So now let's look at the valuation and see how they're valued amongst each other. When it comes to valuation, I like to do a quick calculation just to see how the banks are valued compared to each other. I use Ticker for that. You go to the valuation tab, you look for the bank, you add them in, And then I like to come to multiples and then look at the forward PE ratio. And I like to use a longer time frame so that we can smooth out the peaks and troughs, because the pandemic crash will be essentially a peak and a massive trough. So we want to smooth that out just so that we can put things in context. And you can see that the CBA valuation right now is around 20 times. And historically speaking, is trading at a forward PE of around 15 times. So you're definitely paying more than usual for CBA's valuation at the moment. And you can say the same thing for Macquarie as well. Same thing for Macquarie, same thing for all 5 banks, to be honest. Another way to think about valuation is that CBA has a forward PE of 20 times, right? So if we bring out the calculator and we go 1 divided by 20, you can see that for every $1 that investors are allocating to CBA, they're buying 5 cents of future earnings. Now, historically speaking, investors, if you will, were paying 15 times forward PE. And if we do 1 divided by 15, you can see that with $1 that they allocate to CBA, they were buying 6.6 cents of earnings. From a valuation point of view, all of the 5 banks are trading above the historical average forward PE. So it's not exactly a bargain. But in saying that, their dividends are recovering, and in a rising inflation, rising interest rate environment, that's really going to help the profitability of the banks. As it stands, I have enough exposure to the 5 banks in my portfolio. So I'm definitely not looking to build any specific position in the banks because I have enough of it. And I have to say, this video will be a lot more interesting if I include the US banks or Bank of Queensland or Bendigo Bank. But if there was one bank that you're interested in, which one would that be? Let me know in the comment section below. With my CMC market portfolio side of things is worth about 94,000 Australian dollars. I have made no changes on this side, and I still have quite a bit of cash I need to allocate over the next couple of weeks. I will keep depositing money into these accounts just because I think it's better to just sit at the brokerage account than to sit in my bank account thinking that I have money to spend. It's a weird psychological hack that I have, so that keeps me motivated to find opportunities or invest consistently. But at least on this side, I have made no changes. With my stake portfolio is worth about 38,000 USD, and that's approximately around 48,000 Australian dollars. So over the week, I added more into Myers, and I am planning to build this position to be bigger. And I really wanted to add more into CVS, but it went on a run, so I didn't really get a chance because I wanted to let it cool off. I've added a little bit more into COPEX as well, which is my copper exposure. On top of that, I did add a new position. I'm not quite ready to share that with you yet, so I'll share that with you next week. And GoPro, Dropbox, these are free stocks that are given to me if you do decide to try a stake for yourself. I'm not sponsored, but if you do want to try a stake for yourself, I left the link in the description box below. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.